Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday market recap. So in today's markets, the bulls just continued their march upwards as the bears are showing no signs of interest of shorting this market yet. So we're going to take a look, is the rally currently sustainable? I have a few metrics that we're going to go over together to make that determination. As well, we're going to go over a few earnings reports that I have prepared for you guys for today. Number one is going to be Expedia stock, a very interesting play considering their most recent earnings sell-off. And stock number two is going to be Pepsi, one of the stocks that I've preached for a long time on the channel as being a very good value play that you can basically buy in and forget it for the long run as the company just churns out profits year over year. So we're going to take a look how they did on their most recent earnings call and if they gave any hint at consumer discretionary spending being healthy or negative. And as usual, guys, we're going to cover our major technical analysis on our indexes and our major tech names. And lastly, wrap up with my portfolio, see how we ended the week. So without further ado, guys, let's get right into today's video. So SPY up 0.58%, QQ up almost 1% on the day, and decent performance overall by the rest of your market segments. Your two other major segments, XLF and XLV, performing fairly adequately as well. XLV taking a little bit of a breather, but financials performing well. IWM Russell with another day of outperformance, however, 1.63% to the upside, and that is the second day in a row that the Russell growth stocks are now moving contrary to yields. So usually they have an inverse correlations, meaning whenever the long-term yields, such as the 10 or 20-year, go up, usually your growth stocks go down just because a lot of the components in your Russell are either money-losing companies that haven't yet become profitable, running a lot of debt. So when interest rates go up, the price of that debt obviously becomes more expensive, and it really has an impact there on their ability to generate cash flows. But the Russell bucking pretty much that trend here today, really going contrary to your move in yields, which is very nice to see indeed. So a couple little metrics that I want to go over, guys, in terms of are the markets overbought or not? Well, obviously, when we do the technical rundown, guys, we've seen that most of your indexes on a daily and weekly basis are now starting to get a little bit overbought here on your weekly RSI. SPY, QQQ is also being plagued by this. Financials are overbought. Healthcare is getting overbought. And Dow Jones as well has been overbought on the weekly now for a couple weeks in a row. So overbought conditions on the technicals for sure. Number two, you have your seasonality potentially coming into effect. After a nice start to the month of February, we could be expecting a little bit of a retrace into March as well, as we now know that the March rate meeting for the Fed will most likely not be cutting rates. So no bullish catalyst there for the market. So end of February through March could be a little bit of a lull period for the markets as we don't have any more earnings, no more bullish news coming out of the Fed either, just a few CPI and jobs reports to be expecting. Now, we also have our fear and greed index. We have now recently most tapped into the extreme greed category for the first time in over a month. It was really stuck at that greed index indicator here for the past 2 or 3 weeks, but now we're kind of delving into extreme greed, which really shows that traders are starting to feel a little bit more of that FOMO as we have led into the past couple of weeks, coming off a lot of tech earnings that have generated massive returns. So a lot of people trying to chase the trade into overbought conditions, not my preferred trade, to say the least. And now we're also going to take a look here, guys, at a few of your long-term indicators. The first one that I did want to bring up here is MMTH. So this is the percentage of stocks above the 200-day average. The last time we pulled this up on the channel, I usually pull it up when we get to extreme levels. The last time notably being the end of October after the pretty much August, September, October sell-off that we had over here. You can see that all stocks were pretty much crushed, with only 23% of them being above their 200-day moving average. 200-day moving average is a very important technical indicator for most stocks and indicators, and it goes without question that when most of the stocks are below their 200-day moving average, guys, it means we're really approaching broad market oversold conditions. And if you take a look at this long-term chart, you can see that usually we get down to about a read of about 20 to even 15 at the most extreme levels before you tend to see a little bit of a bounce. This is just broad market bounces and sell-offs. And when we get closer to the 65-70 level, which is the top end of this range, meaning that 65-70% of stocks are trading above their 200-day moving average, it could be synonymous with a relatively overbought market, overbought conditions across the board. and a little bit too much bullishness. So now we have a current read of 60 approaching our high levels here, but not quite as high as we have been in the past. So could be a little bit more room to move on this rally, maybe an extra week or two before we potentially get that seasonality kick in. So just keep that in mind, guys. We are fairly overbought on a lot of indicators, and also your sentiment is now into extreme greed. So now still remains a time, in my opinion, to be fairly cautious in the markets. Now, in terms of breadth, are we doing good on breadth? Well, yes, usually for breadth, we measure something called the advanced decline line. This just measures how much percentage of stocks have been advancing versus declining. It gives us a good indication of your market breadth. How many participants are participating in the rally? Is it just a few or is it many? Well, here on the S&P 500, you'll see that the advanced decline line indicator correlates with your S&P 500, meaning that most companies in the S&P 500 are participating in the rally. The Dow Jones shows more of the same data. However, the discrepancy arises when you take a look at the NASDAQ versus the NASDAQ 100. So these are two completely different things. The NASDAQ 100 is most represented by stock symbol QQQ, which most people know. And you can see here that your NASDAQ 100, yes, all 100 major components have been advancing for the most part. But when you took a look at the NASDAQ as a whole, which comprises over 3,500 stocks, it paints a different picture. The NASDAQ has been going up, but your advanced decline line has largely been flat to down ever since the start of the year. That just means, guys, that your major movers in your technology index in the NASDAQ as a whole has been your Magnificent Seven complemented with your semiconductors. So a little bit of discrepancy here in terms of tech stocks, which kind of reiterates my theory, guys, that for the most part, tech stocks are the ones that are getting significantly overbought on daily and weekly levels. And if we do get a late February and March pullback after this earnings season, it may just be possible that QQQ has the largest dip or consolidation out of all of your indexes, while healthcare and financials may be able to keep up their gains or at least maintain relatively flat to slightly down positions, as QQQ may outpace to the downside, which would lead to outpaced moves to the downside for QQQ, but SPY really coming in for a potential shallow dip, while QQQ may be a bit more aggressive and try and correct this discrepancy here between your top 100 companies in the NASDAQ versus the entire rest of the index. So those are just a few thoughts here, guys, on the status of the market. As I've said, yes, we are in bullish conditions right now, overbought conditions. Can they remain overbought? Yes, but this usually doesn't last forever, considering the fact that some of our technical indicators are overbought and our sentiment indicators show extreme greed. It may still just be a time to be a bit more cautious and prudent with the stocks you are choosing to invest in right now. Wouldn't be chasing stocks at all-time highs, in other words, in my humble opinion. So let's take a look at how the markets did today. So you will see that on the heat map, everything has been doing fairly well. That was the 1 month. My apologies, but here's your one-day performance. You can see that slight little drawback in healthcare. Financials performing well, and big tech as a whole performing well indeed. But your bottom half of the market, industrials and some consumer stocks as well as energy, really not having the best day at all. So on your one-day relative performance, that is shown right here. Technology, consumer communication services, consumer cyclicals, financials up, but a couple negative indicators here on the market. On the 1 week relative, everything is rather the same as well. Your uptick in yields severely hurt the utility play and consumer defensives for a large part, but your technology stocks have been large outperformers on the course of the week. And the 1 month shows a relatively similar picture. Your negatively affected stocks by the rise in interest rates have been real estate and utilities. That goes without saying. The correlation is fairly obvious. And your outperformers, really, technology, communication services, financials, and healthcare still in the green. So on the 1 month relative, everything looking fairly good. Just goes to reiterate, guys, that you really, the division in the market right now, interest rate sensitive stocks versus non-interest rate sensitive stocks. Obviously, your non-interest rate sensitive stocks have been largely outperforming the stocks that are beholden to any changes in interest rates. So before we go over further of our technical analysis, guys, let us get into two earnings plays, and we'll go over these relatively quickly. And the first one is going to be Pepsi. Now, just to preclude, guys, in terms of your earnings plays. So the reason why I've started doing a bit more in-depth analysis is just to provide educational insight so that potentially you guys can do this on your own. Now, my goal for doing the fundamental analysis is to prove that it doesn't have to be a hard or a long process nonetheless. You can really spend only about 5 to 10 minutes reviewing these quarterly earnings when they come out and get a pretty good sense of where the company is standing in terms of a snapshot of their financial performance, right? We only want to look for a few notable things while we're doing fundamental analysis, guys, and these are all really self-evident and fairly easy things to understand. Is the company profitable? Number one, that's what I always look for, right? Number two, is the company growing revenue while keeping its costs low? That's another thing we want to see. Can they grow revenue, but also control their costs, basically improving their margins? That's a very big thing that I look for in a company as well. Number three, is the company generating free cash flow? Why do we look at free cash flow, guys? Because that's the money that they can use to either buy back shares or pay out dividends. So it's a very good indicator in terms of the financial health of a company to be able to return some of that money to you, the shareholder. And, you know, another little thing is the company's earnings per share expanding? So obviously you guys are fairly familiar with the price to earnings ratio, right? In terms of a reflection of a company's stock price versus the earnings that they're generating. Well, we want to see when a stock price is going up, we want to see that being justified by an underlying increase in your earnings per share. If the stock is moving extremely fast to the upside, but there's no increase in earnings per share or no meaningful increase in earnings per share, you can tell that most of that move is driven by speculation and not necessarily by fundamentals. A big case of this recently has been the move on AMD, which we commented on during their earnings, after their earnings a few weeks ago. And number five, is stock compensation a problem? So this is one that we've been looking at in every single company earning so far, and it just goes to show you guys that a company can be very profitable, but give away too much money in the form of stock compensation to employees and management, which really takes away from the company's ability to return money to you, a shareholder. And also when there's too much shareholder share compensation to employees and management, it dilutes the amount of outstanding shares. And a few examples of these, yesterday we looked at Cloudflare, and the reason that I did not like their earnings is they had too much stock-based compensation. It is ruining their ability to generate a profit. And the second company was Google. About a week and a half ago when they reported earnings, one of the highlights that I did not like, the only thing that I did not like from their report, was that the continued increases in stock-based compensation was really plaguing them to generate more and more net margin. So those are just two of the effects. So hopefully in the reviews we're going to go through today, guys, hopefully it helps you to really start breaking down a few of these on your own in your own free time. If you want to, if any companies you own in your portfolio, if you're questioning where they're at, this is a very easy way to do it. Just look over their earnings. So number one is going to be Pepsi. What happened with Pepsi today? They had a beat on EPS, but a ever so slight miss on revenue. So nice little beat on EPS, and they did have a beat on revenue as well. Few of the highlights, very solid 2023, guys, from Pepsi. They're back to very high levels of free cash flow as well, which we're going to see. They have very high brand power. Obviously, it's a well-known brand, and they have names. Obviously, they have soft drinks, but they also have the Gatorade brand, and they have a number of chips distributors in the names of Frito-Lay. They also have very decent cost control, so Pepsi's been improving their net margins over the past couple of quarters and wants to maintain an efficiency ratio here going higher into 2024. And number five, they had some comments on discretionary spending in terms of if the consumer was healthy or not. Now, Pepsi, I've always stated that as long as we're between about $165 and $155, it's a very decent buy zone for me. You can tell on the chart from Pepsi, we don't really get below this 26 orange line. That's the 26 EMA. This is a monthly moving average, and every time we dip below there, we usually get a swift rebound back to our norms here of being above the moving averages. So Pepsi's still trading at a discount relative to its all-time high of about 15%. One of my favorite discounted plays in the market, Coca-Cola, is obviously a very sound bet as well, as Coca-Cola is significantly still off their all-time highs. Relatively the same, guys, about 11-12% off their all-time highs. Either one of the two, Pepsi or Coca-Cola, I like very much. We'll be going over Coca-Cola's earnings back into going over Coca-Cola's earnings next week when they report on Tuesday. As a whole, fairly decent quarter by Pepsi, guys. So let's take a look at some of the headlines here. PepsiCo earnings top estimates, but quarterly revenue slides for the first time in nearly 4 years. Not missing by much, but they did miss. Company's net sales fell by 0.5% in the fourth quarter, so not that great. Pepsi executives said high borrowing costs and lower personal savings have squeezed consumers' budgets, something that we've known and that we've been commenting on now for a while. The CEO said that U.S. sales broadly slowed down in the fourth quarter, part of that slowdown is due to pricing and consumers' disposable income situation, he told investors on the company's conference call. So Pepsi's in a tight spot, guys. They're not able to raise prices anymore. And here is the sign of this. Consumers are finally deciding to shy away from this. Where have we seen this recently? The McDonald's report. So now at the end stage of an inflationary cycle, now that consumers are tight with their money because of high interest rates, we truly see which companies continue to have pricing powers and which do not. Unfortunately, a lot of these consumer discretionary spend stocks such as Pepsi and McDonald's, unfortunately, are running out of purchasing power. Are they still very good companies? Yes, it just means that their top line revenue growth at this point cannot come from further price increases anymore. It has to come from renewed volume in the product. So those are two things that we'll be looking on for 2024. He added US consumers are also shifting their behavior from eating and drinking at home to picking up more of their snacks and Gatorade from convenience store, which is good. But LaGuardia expressed optimism about the overall state of the consumer, citing low unemployment and hopes that interest rates will fall by the summers and wages will rise faster than inflation. So basically, he's hoping that consumers get more money to buy more of his drinks and snacks. Now, net sales dropped less than 1% to $27.85 billion. It's the first quarter since 2020 that the company's quarterly revenue has declined compared with the year ago period. Pepsi's organic revenue, which excludes acquisitions and divestitures, all the time, guys, when you read organic revenue, it means what can the company do on its own without acquisitions, mergers, and investments, rose 4.5% in the quarter, which is good, helped by higher prices. But those same raised prices have hurt demand for the company's food and drinks, aka they're running out of pricing power. PepsiCo executives said high borrowing costs and lower personal savings has squeezed consumer budgets. Yes, Pepsi's North America Quaker Foods divisions reported an 8% decline in volume. A voluntary recall of its granola bars and cereal hurt its sales during the quarter, along with weaker growth from the overall category. So a bit of a one-time event here in terms of their Quaker Foods division, but still something we need to keep an eye on. Frito-Lay North America, which includes brands like Doritos, posted a 2% drop in volume. So there's another drop in volume. Pepsi's North American beverage unit saw its volume fall 6% in the quarter. For 2024, Pepsi now anticipates organic revenue will rise at least 4% and earnings per share will climb at least 8%. So good little bump here that they're able to still increase earnings per share on a year-over-year basis. Consumers are likely to remain watchful with their budgets and choiceful with their purchases. Now, Pepsi, how do they stand in terms of fundamentals, guys? You'll see that this company is everything I'm looking for. Ever expanding EPS over the next 4 years, despite the relative troubles that they've been facing in this earnings call transcript that we were just going over, still ever expanding EPS over the next 4 years. In terms of revenue expansion will also be happening at a rate of about 4 to 5% per year for the foreseeable future. Fairly good. Pepsi does generate fairly decent net margins as well. Quarter over quarter basis, guys, you'll see that it's always between 12 and 13%. Not as much as Coca-Cola, which is over 20%, but still very decent margins as a whole, guys. So those are a few of the things that we did want to look at. We also want to take a look at their free cash flow. So we'll get into that as soon as we do this. So here's some further commentary from Pepsi here. We're pleased with our results for 2023. PepsiCo delivered 9.5% organic revenue growth. This compares to 14.5% organic growth in 2022 and brings our 3-year compound annual organic revenue growth to 11%. Very good. This strong top-line performance coupled with the benefits of robust cost management programs resulted in 100 basis points of core gross margin expansion. That's 1%. So very good as well. As a result, our core constant currency EPS increased 14%, the third consecutive year in which we have delivered double-digit core constant currency EPS growth. Very good. In addition, here's a big one. Free cash flow improved nearly 40% to $8.1 billion, and we returned $7.7 billion of cash to shareholders through $6.7 billion in dividends and $1 billion in share repurchases. This is why free cash flow is so important for the dividends and the share buybacks. And you can see Pepsi here has been a bit struggling with free cash flow generation in the last couple of years. You can see that ever since 2015, it's kind of been dropping off. 2015 was that peak where they had about $8.1 billion of free cash flow, been dropping off, and that was a story for Pepsi. But in the most recent year, the bar's not here yet. But now, as you can see, as we just shown, $8.1 billion in free cash flow. So that line should be presenting at the top end of the chart. So they've largely recaptured their free cash flow by efficient cost management, which is what you want to see, which is why I really like Pepsi going into 2024, 2025 as well. Even though they can't increase prices anymore, they've shown really good robustness in managing costs, and it's really Good for them at this point. Now, as we look ahead to 2024, we expect our business to continue to perform well and deliver solid top-line growth in an environment where they expect the consumer preferences and behaviors to largely revert to pre-pandemic norms. Great. Furthermore, we expect our category growth rates to moderate versus recent years with less net revenue realization, reflecting our expectations of moderating inflationary pressures. So they're meaning that they can't pretty much increase the prices anymore at this point, right? So in the coming year, we will elevate the focus on our holistic cost management initiatives to accelerate productivity and use the savings to both mitigate cost inflation and prioritize support for more investments in our brands, innovation, and channel expansion. So that is very good here, guys, right? So let's take a look at their numbers, and this is the last thing we're going to take a look at here. So Pepsi, full year and fourth quarter organic results here. So net revenue performance, you can see that's the loss on the fourth quarter, but for the full year, still expanded at roughly 6%. Very good. EPS change as well on the fourth quarter was extremely good. On the year, only about 2%. And here you can have your organic core fourth quarter and full year. So you can see here your organic revenue growth that is just Pepsi alone, not its brands and acquisitions that it's previously done, right? Is up about 9.5%. Very, very decent. And there's your boost in core EPS, which is about 14% year over year. Now, is Pepsi expensive right now? Well, not so much, guys. They're trading roughly right now at about a PE ratio of about 29, let's say 29, 27-ish. And in terms of their most recent history, you can see that they've always been increasing EPS. Their PE ratio now sitting about at 27, 28, which is relatively high since it's been there in the past, right? But they have been improving EPS by a wide margin. They're improving free cash flow. So necessarily Pepsi is still growing here, deserves a little bit of a higher premium at the current time. And the shares are currently in an extended area of consolidation here, well below our all-time highs. So I do believe that it is a very decent purchase at these levels for the long-term portfolio. If we get closer to 160, 155, it really becomes a no-brainer at that point. So that's pretty much everything I had for you guys for Pepsi. Now, stock number 2 is going to be Expedia. So Expedia, one of my top 3 favorite companies here in travel and experiences. Number 1 is going to be Airbnb. Number 2 is going to be Booking.com. And number 3 is going to be Expedia. All 3 of those companies with very solid fundamentals. So we're looking for the one for the best bang for your buck. And with this most recent sell-off here of about 18% in Expedia, I do believe this one represents a very good opportunity. Now we have one of the patterns that I like the most, the breakout retest pattern, monthly uptrend retest of what? Your 2 moving averages down here at about 122 and previous resistance, which is now going to be support. Beautiful breakout retest trade here. So I will be looking to heavily play this stock into the next few weeks if we continue to get down into the slower $120 area. I think it's a very good area to be picking up some Expedia, and hopefully with the fundamentals I'm about to show you guys, I will showcase why. Now this 18-19% drop is largely due to just them changing the CEO. So the CEO announcing after the earnings call that he was going to step down, which really hurt the stock despite otherwise very good results. So take a look at the results, guys, right? Expedia, right? 2.78% beat on earnings and a nice 0.5% beat on revenue. This company is no stranger to increasing revenue and EPS. We're going to show you that. Look at this EPS expansion, guys, over the next couple of years. That's a compound annual growth rate of about 24%. Anything above 20 is phenomenal. And for Expedia to be as large of a company as it is and still expanding EPS at over 20% for the next 4 years is absolutely amazing. You also have a very nice revenue curve that's going to be increasing as well, largely over 10% a year. So really respecting my rule of 10 and 10. I want to see over 10% revenue growth per year and over 10% EPS growth per year for a growth company, which Expedia still is right now. Now, in terms of their profitability, their profit margins have never been the absolute best, but you can see that they did put in about 6% in profit margins. Now, it's not as much as Booking.com. Booking.com, one of their main competitors, they're always putting in margins anywhere between the 20 and 30% range, so significantly better. And even Airbnb, now that they've been profitable, is putting in significant margins here. We're talking about, about anywhere between 16 and 25% on a quarterly basis for the past year or so. So looking at Expedia, yes, they do generate less margin. However, they're growing efficiently and the management is very, very good. Take a look. They also don't have a lot of long-term debt, something that I did want to show you guys. Another thing we look at the company company, right? So are they growing free cash flow? Are they growing revenue without accumulating debt? Yes, you can see here at the most recent 2023 here, debt of only about $6.5 billion. Free cash flow for the year was about almost $2 billion, and they already have about $5.6 billion in cash and cash equivalents. So enough money and free cash flow generation to clear this debt if they wanted to. It's really going to let the business expand well, in my opinion. So let's take a look at the headlines here. Why Expedia stock dropped like a rock today despite having a double earnings beat. So shares of travel booking platform Expedia dropped on Friday after the company reported financial results in the fourth quarter of 2023. In reality, the numbers were pretty good, but a surprise change of CEO cast a shadow over the financial results. So a little bit of a event that nobody was predicting, right? Expedia generates revenue in several ways, including processing travel bookings, earning commissions, and advertising. In 2023, the company generated record revenue of $12.8 billion, including Q4 revenue of $2.9, which was up 10% year over year. So the travel boom just continues, guys, and this is going to be a trade that will continue over the next 2-3 years. Much of Expedia's operating expenses were little changed, which was good for profits. This is exactly one of the criteria I was talking about. Can they grow revenue while keeping costs the same? And here it is. Operating expenses little changed, even though massive revenue expansion. However, there were bigger factors at work. The company repurchased $2 billion in shares during the year, and higher interest rates provided higher interest income on its cash. Therefore, its full-year diluted earnings per share made a huge 145% jump in 2023 compared to 2022. This is looking on a quarter-over-quarter basis. Now, regarding its forward guidance, Expedia is loosely expecting its revenue to grow by 10% in 2024 and thinks its profit margins can modestly improve. Given its record year and reasonable valuation, one would think Expedia stock would be up today, not down. And that is very, very, very true. Let's take a look, guys, at their earnings, and I'll show you exactly what we're dealing with here. So really nice increases across the board here. So we're going to go over the fourth quarter and then the full year as a whole. So booked room nights, guys, 77 million as compared to 70 million in Q4 of 2022. That's very good, 9%. Gross booking. So obviously this is not Expedia's revenue. They obviously operate with different travel partners. This is just the gross bookings. Then they have to obviously pay the hotel or the flight and whatnot, and then they keep a little bit of the end revenue, of the end profit from those transactions. So gross bookings was up 6%. The revenue as a whole was up 10%. Very, very, very good. Their operating income slightly down, however, from 2022. Right, and adjusted EPS, very good increase here, 37%, and even adjusted net income, very, very good increase quarter-over-quarter basis. Now, for the full year, everything looks very, very good for the company. Booked room nights, 12% year over year. Gross bookings, 10%. Revenue, 10%, right? Extremely good numbers here. Adjusted net income up 32%. This is your bottom line income up 32%, right? So if we just take our adjusted net income right here, which is going to be about 1418, divide that by their total revenue, 12,839. That's going to be about profit margins of 11% for the past year. 11%, guys, really representing a nice increase after struggling post-pandemic. They're now back over and above the margins that they've had for the past 5 years. You can see last year was about 6%. Now they have about 11% margins, which is very good, and nice free cash flow generation as well. They did generate less free cash flow than the year prior, but still about $2 billion in net free cash flow. So very, very good. I like Expedia. It is one of my favorite travel plays out there. I do think technically it's extremely sound at these levels. We're just looking for the monthly breakout and retest. You can see this area right here, guys. This whole 120 area has been a very, very big prominent area of resistance all over the course of 2022. So we should be able to use this as a bit of support and really start moving on. Now, in terms of the one last ratio that I wanted to show you guys here. So let's take Expedia's price to earnings ratio, right? I want to show you why growth in EPS is so important, okay? So let's take their growth metrics. So 2023, their EPS reported was about $9.69. So let's take their share price of $131 divided by their earnings per share, which is about $9.69 reported, gives them a price to earnings ratio of about 13.5. That's not very high at all. The rest of the travel industry, Airbnb is a bit higher, but Booking.com also trades at roughly about an 11, 12, 13 price to earnings ratio. So this is in line with the rest of the industry. However, let's take into account their growth of EPS per year, which is about 24%. So we're going to divide this PE ratio by the growth rate of those earnings to get a PEG ratio, price to earnings in relation to their growth. And you can see the PEG is only about a 0.56. This is absolutely amazing, guys. It means that the stock is trading at a relative discount, right? So this is what you want to see, a PEG ratio of under 1 for a growth company that is growing very nicely. It is still relatively decently off their all-time highs by about 40%. So it is a very good deal. The valuations are very nice, and hopefully the PEG ratio paints a better picture of that. After going over a few earnings yesterday, guys, right, in the names of, let's say, things like Cloudflare, right, and other companies that we've gone over this year, over this past quarter, right? You can now tell that a few companies had extremely high PEG ratios. If you take a look back at Cloudflare, I don't know if I still have my notes up there, but I do. They had a PEG ratio here of about, if I'm not mistaken, about 4 or 5, right? 5 PEG ratio for Cloudflare, and they're not making money. So it just goes to show you, right? Cloudflare is growing, but Expedia, a more mature company, is growing just as fast, and they don't have a lot of debt either. They're a profitable company, and their price to earnings in relation to growth is extremely low. This is where you find true value, in my opinion. So very nice play here on Expedia. 120, 125. I am definitely going to start picking up some shares and potentially playing some options on the wheel as well. So that's pretty much everything I had for you guys in terms of earnings. Now let's take a quick rundown of our major indexes, and then we'll get into the tech names and then my portfolio. So your indexes, simply continue, guys. We're going to go over these quickly because no pattern has changed as of so far. So your short-term bulls are still in control of this hourly uptrend, right? As long as the bulls control this hourly uptrend, not expecting daily consolidation. As soon as you see an hourly downtrend, your daily consolidation is underway, and now the bulls have created a ton of space. Any pullback at this point is just going to be looking for a daily higher low, anything above 482, just looking for that daily higher low for further trend continuation. But we are getting a little bit overbought on the daily and on the weekly chart as well. So just be mindful of that. Keep a big eye on your 12 EMA. 12 EMA has been a nice area of defense ever since the November rally. So if we lose that coming into the next few weeks, it's going to be notable to us, expecting that weekly pullback. On the weekly, everything is looking gorgeous as well. Very nice third leg of your weekly uptrend as well, significantly past your all-time highs at this point. So it stands to argue if there's a larger form pullback to occur in the markets, your likely pullback area is now going to be the all-time highs. For a significant pullback at this point, that could be about 3, 4, 5% pullback. We're talking support between 480 and roughly about 470 levels. And still, any pullback on the weekly, guys, just looking for a higher low, anything above 466, higher low, right? And your monthly bulls have always been in control. So really, if February and March do tend to be a little bit more negative, it's just going to be for a temporary pullback before your bulls just remain in full control of this market for 2024. Now, moving on to QQQ, largely the same, right? So beautiful daily uptrend at this point. As soon as this move tops out, just looking for a daily higher low, anything above 416, just looking for that daily higher low for further trend continuation. Keep in mind, we do have a nice previous area of resistance right here at about 430, which is going to coincide with your 12 EMA as well. So it could be a first line of defense, but then if we roll over, we're just looking for a weekly higher low, anything above 396.04, weekly higher low for further trend continuation. At this point, we're significantly above your QQQ all-time highs previously, which is about 406. So if we do get a retracement, guys, I'm expecting your first 12 EMA to act as defense, and then the upper part of this area, 405 to 400, should be a significant area of support. If we do pull back there, we're talking about a roughly 6, 7, maybe 8% pullback on QQQ. Would not be surprising to see that eventually, guys. These markets are significantly due for a correction soon, potentially lining up with our seasonality here, but it's not going to be an overall nasty correction, just a nice long-term buy the dip opportunity. Now moving on to financials. Financials also looking good. We were commenting on this tightening range. Well, it's still tightening up here, guys. What you love to see is a tightening range at the top end of a move like this, right? Big move, and then just tightening range. This is just a bull flag, guys. It's just an accumulation zone to potentially break the levels further to the upside, never losing this 12 EMA the entire time. So that's what you love to see. This is a perfect bull breakout scenario, in my opinion. On the weekly, everything looking gorgeous as well. After a few weeks of pullback leading into the beginning of the year, we are now on to weekly leg number 2, and your overhead levels of resistance on XLF do remain at this point 40.75. Well, pretty much 40 all the way to 40.75, which is going to be your previous all-time high. So getting into those areas fairly quickly, and on the short term, guys, everything is quite looking bullish at this point, right? So we are expecting just a continued breakout on financials over the course of 2024, as we are in potentially a rate decrease cycle that is imminent right around the corner, potentially in May, and usually financials will tend to recover quite quickly when those rates do come down. Looking absolutely gorgeous, though, on the monthly breakout so far. So it could be a little bit of resistance coming up from your previous all-time highs, but now I'm very pleased that we're much beyond this this 37 area of resistance, which was resistance for a very long time for financials, guys. Now largely above that, so I do believe we're in a brand new cycle for financials. Now moving on to healthcare. So healthcare even coming significantly up from its all-time highs, closing at about 144 here today. Previous all-time highs about 143-ish. So we are starting to create some distance from those previous all-time highs. Daily uptrend looks gorgeous at this point. We're just looking for a daily higher low. Any pullback, just looking for a daily higher low for further trend continuation. Now keep in mind, this red line is the previous all-time highs, but this yellow line is previous area of resistance, which should now be acting as support. You do have the 12 EMA right down there, right? So this is going to be a very nice area of confluence. If XLV bulls need to take a break here, this could be a first line of defense before further increases. Looking on the weekly, everything's looking gorgeous for this weekly trend expansion as well. No red flags there whatsoever. And on the monthly, everything looking very good for monthly real breakout of your previous all-time highs. This is what we were talking about in the later part of 2023, how XLV had been muted this entire time. And when they break out, the breakout is going to be absolutely nasty, and it is going to be a heck of a move. So I'm expecting break to the upside and potentially reaching levels such as about 160 over the course of the year. Would not be surprised after XLV spent so much time accumulating. That distribution towards the upside is going to be fairly significant. Now moving on to IWM Russell. Really doing a good job here, even though yields have been going up. IWM Russell also going up on the day. So now starting to challenge our previous area right here, 199.50. We're almost there right now, guys. If they can get this done, they would be setting up for a daily uptrend here. So we were looking for the bears capacity to really drive a daily downtrend into this market, but IWM bulls showing up very nicely, trying for the daily uptrend break of 199.5 would just be daily uptrend confirmed at this point, and then there would be a major sign that your weekly move is simply resuming as well to the upside. If we can close a weekly candle, guys, above 201 pretty much over the course of the next couple of weeks, it could lead us into, if we do get that end of February, early March sell-off, you would need to see IWM all the way up here to about 210. When we do get that sell-off, sell back, use this whole red box, which is previous resistance for a year and a half, use it as support, but we need to get over and above. If the sell-off starts before we've cleared this area, I'm quite fearful that unfortunately bulls will lose this momentum and start trading back towards the midpoint of this massive range right here, which is about 187 down to about 180. That's where I really start building heavy positions in IWM myself. That's what I've been waiting for. Was getting a bit greedy, right? I could have picked it up a few times here, but I'm really waiting for that, as I am expecting our seasonality here to kick in February and March. So really expecting to get it down here. But if we do close out above this and start retracing into it, then I will have to readjust my targets, because that would obviously be a mount, close above, breakout, or retest trade. And then I will be taking my trades from this area as support. So hopefully that gives you some insight how I'm looking at the Russell. Now moving on to Dow Jones. Doing its thing, right? 0.14% to the downside, but daily uptrend is absolutely gorgeous at this point. Continuously bullish uptrend right now. 12 EMA is looking as your first line of defense. So if we lose this, that what needs to be notable to you guys, but everything looking very good. Any pullbacks at this point, just looking for a higher low, anything above 38,178. Higher low, further trend continuation, looking fairly decent, but we are getting slightly overbought on the Dow Jones right now on terms of the weekly. Weekly pattern, though, is looking gorgeous. Weekly breakout and continuation now well beyond your all-time highs. So even if we do correct in the next few weeks, I don't believe we're going to get all the way back to your all-time highs. Your weekly higher low is right here, 37,118. If we do pull back here, guys, I'm potentially looking for a retest of this area, 37,800. Previous resistance should now be newfound support. And if we act there, if we kind of trade sideways for a while, it'll allow for your 12 EMA to catch right up to the price. That could be a decent area of confluence, but no red flags for the Dow Jones whatsoever right now. Now, let's do a little bit of crypto, because crypto had some outsized moves in the past few days after moving sideways. So whenever crypto moves sideways, I don't really determine that it's notable to be covering. What we were looking out for after the size of this move to the downside and loss of your weekly lows, we were looking for a potential weekly lower high and then potentially lower low. We were looking for the size of the bounce as soon as the bears recaptured the daily uptrend right here. We were looking for the size of the bounce. Now the daily uptrend continues at this point, and now we're starting to retest the highs. So on the weekly here, you have an almost 100% engulfing move on the weekly, gives the bulls a very good chance at, if we do consolidate from here, not being able to break the area of 47 to about 52. That's a very significant area of supply in previous markets here in 2022. So that seems to be the big area of resistance that the bulls are going for right now. Now, if we can't get through there and we start retracing a little bit, I need to see them hold 44,000, which is your previous weekly resistance right here. No candle was able to really close above that 44K. So if we do pull back, I'm expecting pullback into 44K, letting this 12 EMA catch up before a potential weekly trend continuation pattern to the upside. Now, our monthly consolidation, unfortunately, did not manifest just yet. So that's what I was saying here, guys, right? It all depended. If we set the weekly downtrend, that would have been monthly consolidation. Then we could have expected consolidation into February and March. But now, since they want to have a second stab at this area of resistance, it may look a little bit like this. We are going to probably take a break in March. The Bitcoin halving event is in April, and rates don't come down much before the month of May. So not expecting some insane bullish catalysts for crypto much before then, which is why I do think that this rally, although nice, is just temporary for the time being. Still a decent area to be looking to take some short-term profits. Personally, I am looking for Bitcoin. If I can get Bitcoin back in the sub 40K range, that's why that's where I'll be doing a little bit of DOS collar averaging. But I'm expecting good things from crypto from 2024 as a whole. Now let's move on to Ethereum. Give me a second. All right, so moving on to Ethereum. Right, $2,500, doing very, very good. So your short-term bulls are in control. We're looking daily downtrend. Can they get a bounce going? They got the bounce going, setting the daily higher lows. Very painful experience. And now we get the break above higher. So daily uptrend confirmed to the bulls at this point. So your weekly bounce is underway. And now you can see from this candle right here, they've now recaptured about 61.8% of the move, which gives the bulls the best chance, if they can't V-shape this in one shot, to at least have a chance at the two-step process in just recapturing this weekly. Now, they never lost the weekly, contrary to Bitcoin, right? Never lost these lows. Bitcoin lost the lows. That is the main difference between Bitcoin and Ethereum right now. Ethereum looking very, very good for continuation. If we do get continuation, guys, I'm expecting continuation into about 2,700. Would not be surprised for that level to come up again before potentially tapering off here into, let's say, late February, early March at this point. So nice little leg up, but I am expecting this move to be fairly muted in terms of upside gains, meaning I don't think personally for crypto that the monster rally to where we're going to start doing this is going to happen much before May and June of this year, pretty much. So until then, just a very good time to be accumulating, but nice to see that the bulls remain in full control here. Daily control, weekly control on Ethereum, and monthly move just continues to go on higher at this point. As long as we don't set a weekly downtrend, we're still not due for further monthly consolidation. So keeping an eye on that. Now let's move on to big tech. So let's take a look at big tech here, guys. Apple flat on the day, 0.28%, still struggling within this pretty much area. 190 down to about 187 was this big area here of support previously. It gapped through there in the beginning of the year, right, off of the negative Apple Watch news. And now you can see we've been using this area kind of as a little bit of resistance area. But what has Apple been doing? Apple is desperately trying to change this back into a daily uptrend, right? So they had the daily uptrend here that unfortunately slid off with earnings, lost it. Now they're trying to recapture it. But all of this is happening within the context of a weekly tightening range. This is a very beautiful weekly tightening range. Nothing wrong with Apple as a whole as a company. If they do come down 181 to about 175, 170, that is the juicy sweet spot that I want to be picking up Apple. Just an area of monthly consolidation as well. Your monthly 12 EMA is right in there. And you can see Apple usually doesn't lose this monthly 12 EMA unless market conditions as a whole, like 2022, severely deteriorate. So looking for that area to play out as support. Now, just looking to recapture this daily uptrend right now. I like the size of the bounce. Keep in mind, Apple bulls have now bounced from this most recent downturn. They've bounced over 61.8, which gives them a very good shot here, guys, at potentially recapturing that daily uptrend. And then we will be making another stab at the highs of your weekly tightening range. But for now, Apple just sideways price action in the context of a fairly wide range. If we do come down here, that's where I want to buy some Apple. Now moving on to AMD. AMD also sideways consolidation, right? So tightening range at the top end of one of your weekly moves. It's a very good case scenario for AMD considering their earnings that they had that I wasn't that much a fan of. I absolutely love this company, don't get me wrong, and I think they'll be able to do very powerful and good things and compete with NVIDIA for their data cloud warehousing management services. However, that being said, the earnings still need to be realized, and that is something that AMD unfortunately has not been able to do as of just yet. Remains to be seen if they'll be able to materialize all these gains they've been talking about in the next few quarters, but as of now, still not materializing. Most of this move, guys, has been coming based on speculation, not by an increase in the company's fundamentals as a whole, as we showcased when we went over their earnings about roughly a week and a half ago at this point. So on the technicals, daily uptrend, well, they kind of lost it, but we're trying to just hold this tightening range at the top end of the move, just weekly consolidation at this point, right? So your weekly uptrend is very, very healthy still, just in the mode of weekly consolidation, using this area of support nicely. It's your previous all-time highs, 164 to about 158. Now, AMD, very crucial to hold these levels tight. If you get a break of this to the upside, your daily uptrend simply continues. But if we get a break of these lows to the downside here, well, unfortunately, daily downtrend started, weekly consolidation continues, and then we will look to the lower end of that support, 158, and then you have your 12 EMA here right at about 152. AMD becomes a better buy for me, anything under 140. I know it's a significant ways away, but that is just my price target where I'm comfortable really buying a lot more shares of AMD and playing them more comfortably at more sustainable levels for what their current fundamentals do support. But all in all, bulls still looking good here, still playing decent defense. Watch for the break of the lower level, and if they break to the higher end, well, just daily uptrend continues, and your weekly uptrend simply continues as well. At that point, psychological level of resistance becomes your $200 level. Now, moving on to Amazon. Significant, beautiful day for Amazon, 2.71% to the upside. So we were always saying, guys, Amazon bulls were in full control after their earnings, right? Daily uptrend, any consolidation, looking for a daily higher low for further continuation. There's your further continuation, right? So daily uptrend just continues whenever this move tops out, looking for a daily higher low, anything above 167, pretty much daily higher low continuation. Weekly uptrend, absolutely gorgeous weekly uptrend right now, full bull on swing mode. We're going to be targeting the higher end of this all-time high range right now, 176.83, let's call it 179, and then your two spikes to the all-time highs are in the 180s. But really, in terms of your monthly candle averages right here, 178, 179 is going to be a very crucial area for Amazon, and we're almost there, so that could be overhead resistance right now. No red flags whatsoever. I love Amazon for 2024. If we do start pulling back here, guys, for every which reason, if we get rejected and maybe the market with some seasonality starts tapering off here, if we do revisit some of these pre-earnings level in the high 150s, I will be heavily and aggressively playing Amazon. Now moving on to Google. Google also very nice increase on the day today, 2% to the upside. Now Google bulls are really looking to recapture a lot of this downside move after earnings, right? So they had the daily uptrend and then lost it with a loss of the lows. Now they didn't lose, the bears didn't gain the daily downtrend. That would be lower low confirmed, but they lost the daily uptrend. So to recapture it, we either need to see a V shape or we need to see a two-step process. Now, with the size of this move down, usually you would expect a two-step process, right? But the bulls have now recaptured from this move down, now recaptured over 61% of the move, almost about 70% of the move. So that gives them extremely good probabilities of, if they do taper off this move right now, the next move down will be looking for a daily higher low for further trend continuation and trend reversal back to the bulls. Weekly bulls are looking amazing. That's why we're expecting that, right? So we're expecting this daily higher low for continuation. Why? Because your weekly bulls are in full control and your monthly bulls are in full control as well. So as long as the bulls control the higher time frames, usually when you get bounces over and above 60%, they're able to recapture the short-term time frames as well. So just keep that in mind. Google looking absolutely amazing. That being said, if we do pull back here, guys, I will be looking to play Google anything pretty much under 145 at this point. 145 down to about 138. I will be playing Google very aggressively. One of my favorite companies for 2024. Now moving on to Meta. Meta pulling back ever so slightly on the day, but you really can't tell because they're still pretty much at their all-time highs, right? So everything is looking gorgeous for Meta at this point. Just potentially looking for a daily downtrend. If we lose this level right here, 452 would be daily downtrend confirmed, and then we're just going to be looking for healthy weekly consolidation after such a significant move from January, right? Maybe in for some weekly consolidation. That's only if daily bulls lose this level. Daily bulls still holding up well, but remains to be seen. If we do get that, we are going to be in weekly consolidation at that point, and then we will be targeting, most likely, guys, the 450, going to be your psychological level right here, and then all the way down to pretty much $400 is the next big area on the weekly. Not much areas of support, as Meta didn't really set any areas of support on this massive launch. There's a big gap there, right? So the next area of support is all the way back down to 400. So just keep that in mind, guys. If Meta comes down to about 420, 425, I will be looking to play some short put options on Meta, but still the company continues to outperform very good fundamentals from our earnings that we covered on them, and now doing a good job of just consolidating sideways and cooling off the daily time frame, but your weekly still does remain severely overbought. So we'll see how this daily consolidation plays out, but I wouldn't be opposed to seeing Meta back down here. Now, moving on to Microsoft. Microsoft looking very good, 1.56%. They hit the 420, guys, today. So Microsoft, new all-time high. Once again, daily uptrend was never in question right here. Tightening range, right? You see a lot of these tightening range patterns that we just went over, right? So AMD had a tightening range pattern like this, Microsoft having a tightening range pattern like this, and you can see why those usually break bullish. If your monthly bulls are in full control and your weekly bulls are in full control, usually these temporary bullish patterns at the top end of a move, tightening range, usually they break bull. So once again, Microsoft bulls confirming the daily uptrend. No surprises there. At this point, any retracement going to be looking for a higher low, anything above 403, looking for a daily higher low for further trend continuation. Looking very, very good. Nothing bad to say. Weekly bulls, full control as well. If we do end up, since we're a bit weekly overbought, and since we are now as well daily overbought, and also a bit of divergence, right? So lower highs on the RSI, higher highs on the market. Usually that means that price will correct to the downside. If we do get that correction, guys, I'm looking for Microsoft. Anything for me would be attractive about, $395, $390 area would be a very attractive level for me, looking to pick up some more Microsoft there. But I don't believe that in major tech, guys, I don't believe we're going to get a lot of corrections and deep discounts this year. So if we do get 10% on a lot of these names, that's when we do need to go shopping. Now moving on to Netflix. Netflix performing well here on the day, right? So this is looking exactly like Meta. Meta, we were concerned potentially daily downtrend. Well, Netflix already did that. And I'll show you guys why it's not that bad. Daily downtrend in the context of such a wide move after earnings is just very healthy weekly consolidation, right? So Netflix undergoing weekly consolidation right now. At this point, anything above 460, just looking for a weekly higher low for a potential retest and second shot at this 575. 575 is notable because it was the 2020-21 high end of the range that it could not break through for a significant period of time. So Netflix, once again, getting stuck in that area. If it does pull back a little bit, 525, 520, that's when I'm looking to play a little bit more Netflix personally. And obviously, guys, if we just start rejecting here and the bulls take full control and close above 575, that's going to give us a very good opportunity here of setting the new weekly or the continuation of the weekly uptrend in motion, breakout, retest of this range. That's when I would really take a heavy trade on Netflix for further continuation. A nice retest of such heavy structure would undoubtedly mean easy continuation for an easy trade. Now moving on to NVIDIA. NVIDIA just absolutely continues, guys. Is NVIDIA going to hit $3,000 before earnings? Let us see. No, that's just a joke, but still, right? So 721 on the day. Bulls just an absolute full control of this chart right now, right? So at this point, when this move tops out, any move back is just for a higher low above 607. And they've created so much space here, guys. How much space is this, right? They can pull back literally, 10% and still just be looking for a very healthy daily higher low for further trend continuation. Absolutely insane. Bulls in full control. Nothing to say. Earnings in pretty much 2 weeks time in 2 Wednesdays. Weekly bulls full control. You guys already know the drill. Overbought conditions on the weekly, overbought conditions on the daily and on the monthly, overbought conditions. But NVIDIA been no stranger to overbought conditions, not just this year, but in years past as well. So when traders love this stock, the short-term technicals apparently just do not matter. So we're going to be looking at this point for technical patterns. If we see a daily downtrend confirmed, only then can we be expecting further weekly consolidation. And in my opinion, this is only going to happen when the broad market has a phase of consolidation. But as of now, no signs of that yet. So let's just keep an eye on your earnings. Upside targets remain 750 and 800 psychological. Now moving on to Tesla. Tesla performing very well today, 12% on the day. And Tesla really starting to grow into this lower high right here. So downtrend was confirmed, right? As soon as I told you guys, as soon as we saw the hourly trend change to the bulls, that's when we need to measure, okay, your daily bounce has started. Now, how high in relation to the start of the most recent move down, how high will we get? Now you see, guys, we've gotten almost back to 100%, right? We've now got over 80% of the move. So finally, so you see these drops here, look, one leg down. How high was the bounce? Not high at all before rolling over the hourly time frames. Boom, another drop. Same thing happened here. Same thing happened here. Weak bounce before rolling over the hourly time frames into lower lows. Now, strong bounce. So now the bulls have a very good chance at reversing this into a daily uptrend, which would start our weekly bounce underway. Then we're going to measure the size of the bounce in relation to this weekly move at that point. But for now, bulls looking very good, getting the job done. You also have daily crossing on the MACD showing momentum pointing to the upside now. And you also do have your RSI now coming back into positive territory, really completing this divergence. We are pointing the divergence, right? Higher lows on the RSI, lower lows on the price. Usually the price corrects to the upside. So that was another example of divergence playing off. So I hope you guys enjoyed that one. There were some very good trades to be made on Tesla this week. Also coming off our lower area. Still area of support 180 down to about 170. Big area of horizontal support and lower end of your downtrending channel at this point. So Tesla looking very good. Bulls not out of the woods yet. I need to see them capture a daily uptrend, and then we'll be measuring the size of the move on the weekly. But in terms of the bounce, guys, I would really like to see them continue this daily uptrend into weekly levels of at least 220. That would be roughly 50% of the move back, which gives them a good shot at resetting this potentially into later parts of Q1 and Q2. Now, let's move on to Palantir. So Palantir looks absolutely gorgeous, pulling back 0.53% on the day, but you really can't tell because it's at the top end of your earnings move again. So Palantir analysis, very easy, guys. Daily bulls full control, obviously at this point. Any pullback, just looking for a daily higher low for further daily trend continuation. Weekly, more of the same as well. So weekly uptrend is now set back to the bulls on Palantir, and we finally have a monthly trend breakout. For the first time in Palantir's history, we have a monthly uptrend. It's never happened before, right? Monthly downtrend. This finally with the break of break and close above 20 on the monthly is going to be a monthly trend breakout at this point. If we can close the month like this, it's going to look very good. But in terms of short-term pullbacks here, guys, dealing with an area of resistance, this whole zone is where previous people would have been trapped from the IPO for the past 2 years, pretty much. So we're going to be coming up on a few notable levels. Obviously, 25 is your first one, and then we have to deal with 27 and 28, the higher portions of this range. So just keep that in mind. Will be relatively difficult for Palantir to get through there in one clean shot, in my opinion. But so far, so good. The bulls are looking good. If we do get a little bit of weekly pullback leading into the next few weeks with some broader market pullback, I will be looking for the breakout retest of this previous range right here. We're talking about anywhere in the $21 range is where I'd be interested in playing Palantir again. But so far, so good. Bulls in full control. And lastly, PayPal. So PayPal also very decent recovery, guys. They fulfilled the exception scenario. So what we were saying yesterday, guys, is it was really unfortunate for PayPal to be breaking below this $60 to $57 area. Not only was it a very heavy area of support and resistance in the past, but also it represented a very significant weekly low. If we would have closed down below there on the weekly, guys, we really would have lost this beautiful series of weekly higher highs and higher lows. That's been the case for the past couple of months. But now with the fact that the weekly isn't closing below there, the bulls still have a chance. So this whole area still proving to be juicy support at this point. You can see how hard we got rejected from it when we moved down into it yesterday into today. Very nice move, 5% to the upside. Now what we need to see from PayPal is recapture of everything. So first, they have to recapture some of this daily move right here. Now, size of the bounce is key. If we can get over and above the $61.50 level, right? So $61.50, the bulls are set up nicely to have a daily upswing and then potentially retest using this 60 to 57 as support, resetting the daily uptrend, and then we'll once again make a stab at the higher end of this downtrending channel, the thing that's been plaguing us for the past 2-3 years at this point. So PayPal recovering nicely after earnings, but very close, very not out of the woods yet, right? Very, very close to being out of the woods. If we can get back above this, but still not yet. The bears are still just looking to set the lower high and lower low. So the size of this bounce is absolutely crucial until, right, if we lose this hourly trend into next week and roll over, unfortunately, that will just be daily downtrend. The weekly comes undone as well, and then we'll be looking to the lower $50 area to find further support. So that's pretty much everything that I had for you guys in terms of the technicals. Now let's take a look at my portfolio. So taking a look at my portfolio here, guys, you can see that we are now finally in the green for year to date. However, we are underperforming our benchmark indexes in the S&P 500 and the NASDAQ. So we're up about 2% year to date, the S&P almost 5% year to date, and the NASDAQ up almost 5% year to date. We had a little bit of a struggle here early on in the year, as a lot of our plays were either interest rate sensitive plays or plays exposed to China. Those two trades have not been performing well over the past month, but we have been generating a ton of premium in the last 3 weeks, so largely making up for the losses. And now that the underlying positions are also recovering, meaning the ones we got assigned are even recovering in terms of the share price, that is why you're now starting to see some outperformance in the portfolio, really starting to recapture some levels, and it is not finished. This will continue, and we are going to outperform the index towards the midpoint of probably this month or next month, really starting to really increase that outperformance in relation to the indexes as we continue to generate more and more premium and await for those underlying positions to come back into the green. Now let's get into the actual portfolio positions. So guys, first off, we're going to start off with two positions that are not there anymore, and those are going to be Starbucks and PayPal. So let's start off with Starbucks. So what happened with Starbucks? We got assigned back here in mid-December here at about $97, and after that, the stock really continued to take a tumble down to the lower $90 range. Now, prior to last earnings, we wrote some covered calls here for February 9th, which is this Friday. We chose to write them for about 68 cents. Now, we were covered for earnings move, but thereafter the stock did move up considerably over the course of this week, and I actually got early called away by the market makers yesterday. Someone must have exercised these 94 calls because they were in the money to collect this dividend. So we did not get the dividend. We got assigned early, called away early. Now, this is one of the risks when you do write strike prices under your assignment price. You can simply get called away at that point. And so our break even after writing all this premium was about $94.15, and we got called away at $94. You can see that right here, got called away here at $94. So we did lose $15 on this trade, and we did lose a bunch of time since being assigned. However, I'm happy to have recuperated that buying power. Yes, it always sucks that the stock rallies into the last week here, where you're trying to recapture some premium. The stock stayed muted for pretty much a month and a half and then went on to have one of its best weeks in the past 2 months. So really can't, unfortunate timing here, but at least we're able to get out of this trade for a slight loss break even. Not most of them all recover to profits, but then again, you always have this one here and there that does just go for break even. Once again, that is one of the risks when you're writing strike prices under your assigned cost basis. Starbucks doesn't have a lot of volatility. That's why I was writing under my cost basis. And then unfortunately this week had one of its best weeks ever, and now back above my initial cost basis. So a bit of a funny one there. Not too disappointed. Just have to pretty much take it on the chin and move on to the next trade. With that $9,700 in buying power, we're going to be able to write even more positions here and start recouping a lot of that lost time. And the second position is going to be PayPal here, guys. So PayPal was a play that we've been in here for a while. As a matter of fact, since August the 8th. And we were leading into this earnings with very high expectations, but my gut feeling told me that unless it was an absolute perfect delivery on earnings, that Wall Street would unfortunately punish the stock as they have for pretty much 6 out of the last 7 earnings, and this earnings was pretty much the same. So leading up into earnings, we had written the $64 calls, which was under my assigned price here at $64 for about $1.64. Now the day before earnings, we were trading roughly at about 64, 63.50-ish, and I decided to buy back the calls at $1 loss, right? Which brought my average cost, brought my cost basis up from 62.45 back up to 63.45, and I chose to sell the shares there as well because I figured that if we did have an earnings drop, well, we would be able to buy the stock again and write positions down here even lower. And if it were to go up, well, I do have, as I've been saying, 500 shares of PayPal with a roughly similar cost basis in my long-term shares account as well. So if it would have went up, would have been happy for my long-term shares, but all across the board, we had written covered calls. I even wrote covered calls on these in my other account too, but we chose to close the position in the trading account really to mitigate the losses. We close it at break even. So you can see that trade right here. We closed these calls back for $2.63 after having written them for about $1.63, and then we sold the shares for $63.42, which means that we really sold them for break even. And now we're going to be looking to pick up more PayPal, the same 200 shares, except for at a lower level. So decent trade, just a little bit of risk mitigation here, considering the fact that I was expecting a potential pullback on PayPal, also leading to the fact that maybe the markets will be pulling back in the next couple of weeks too. So I really wanted to give myself the best chance at getting an even lower cost basis on PayPal. So those are the two positions that we've been in for a while that are no longer figuring the portfolio here. So I figured I should show those to you guys. Now, starting off with the ones that we still do have. So take a look at CSIQ. So those CSIQs right here. So we've been writing these pretty much. If you don't know the story, been in this one for a while, ever since the month of August as well. CSIQ, we got assigned 200 shares at $35. Then we averaged in with another 200 shares at 25, and the stock just continued to drop. The whole time it was dropping, we were writing premium very aggressively. As you can see from all this premium we've wrote, our average cost is now down to $25.14. So the plays we had for this week was the 23 calls. The underlying price ended under 23, so we just pocket all that 23 cents. I did write additionally $23 calls for next week for 55 cents. So our average cost coming down even more. And I do expect this stock to be fairly muted, guys. If we do get a little bit of a market pullback, this stock will really either stay range bound or even trend potentially a bit lower. And I don't expect the interest rate sensitive plays to be coming back much before another at least a month, guys. Really going to need some confirmation on those rate decreases from Jerome Powell before these stocks really get some lift. So even if we do go into $23, $24 range, I'll be able to probably roll these calls for some profit, but I'm really happy to really be within striking distance of my break even as of now. So the next position we're going to have is Affirm. So Affirm, we chose to do a very, very conservative play on earnings here, getting about 37 cents for the 32.5. So that was pretty much 1%. We wrote them for next Friday. What I was looking to do is pull the premium forward. So there was so much volatility leading into earnings that if Affirm would have just stayed flat pretty much or slightly down as it did, well, all of the premium would have come out of these contracts. And that's exactly what happened. So we're going to be able to close these on Monday after 2 days of trading, probably for about 2-3 cents on Monday if Affirm opens roughly the same. And you can see Affirm prior to earnings, they were trading at roughly $49 and rewrote the 32.5. So that was a full 34% away for a week. Now that's a heck of a cushion. That's why I chose to write these plays exactly, and it paid off. Now we're going to be able to close these on Monday for almost worthless. Caesars was a trade that I featured on Sunday's video. In terms of the top 5 options plays for the week, we wrote the 41s for about 23 cents, which represents our 0.5% rule. And they pretty much ended above Caesars, ending 44.50. So obviously these are just going to end worthless. So guys, as a whole, you see that most of my plays that I've been giving you guys for the past 3 Sundays now, all of them have been 100% profitable, no assignments whatsoever. And you can also see that most of the plays that I get assigned in the account, guys, a lot of them are earnings plays, which is why I tell you guys to stay away from earnings plays. Now, I do them because there is more reward involved, but there is also more risk. So if you're not comfortable with being assigned a position and potentially having to write calls under your assigned basis, bring your cost basis down, if you're not comfortable with maneuvering around options and just want to keep it simple, just stay away from earnings. A lot of these plays are earnings plays. Look, Google assigned after earnings, Nike assigned after earnings, Trade Desk no, UPS assigned after earnings, Baba assigned after earnings, right? Palantir and CSIQ, no. But you can see a majority of the plays that we've been holding for a while were earnings plays that unfortunately just went a little bit sour. So just keep that in mind when I put out the Sunday nights videos. They're really the top plays. And you can see, guys, usually when I don't play earnings plays whatsoever, all of the contracts, the premium just ends up in your pocket. So Caesars, another example of that. Palantir now, we're getting called away here. So Palantir, we wrote the 17.5 calls leading into earnings. Obviously, earnings blew us away. That's okay. Am I upset? No, because I do have about 300 shares of Palantir in my long-term shares account. So not too angry at that. We were able to monetize this play really, really nicely after being assigned at 18 in the end of December. It's been about 5 weeks from them, and we were able to generate some premium, bringing our average cost down to about $16.67. Now, we sold them at $17.50 this week, which is about a gain of about 5%. 5 weeks, 5%, that's 1% a week. So obviously I'm not mad about losing out on this trade because we are still within our minimums. We just recapture that equity right here, and we're going to be able to write even more positions. If Palantir revisits the 21 area, I'll start playing it a bit more down there. But so far, so good. Got called away. It was tough to make a prediction. It could have gone either way here, guys. I'm just very happy that we got our expected ROI from the amount of time that we've been in the stock here. Now moving on to the next play is Baba. So Baba had earnings this week as well. We wrote the 69 puts and we wrote the $82 calls. So Baba has been one that we've been in ever since pretty much they last reported earnings last quarter. So about 3 months at this point. We've been able to reduce our cost basis a ton by about a roughly 4 4.25%. It's still down there, so I will continue to write aggressive premium in the $60 range, and maybe even covered calls above here, closer to my cost basis. But Alibaba still fairly muted, so we just walk away with most of that premium for the week, as none of these two strikes hit. So they're going to expire, and we're going to have a brand new slate with Alibaba next week. Now, Fortinet was another earnings play that I took. We chose to take the $55.50 puts, so they were trading for about 29 cents. That is 0.5%. We traded those before earnings, and we gave ourselves a nice 2 standard deviation cushion. So here's the day leading up, pretty much before earnings. It was trading at 67.52, and we wrote the 55.5s. That would have been 18% worth of a decline, and right in my sweet spot zone. So that's why I did not mind taking this play. We took it and it worked out. We pocketed all of those $29 here for the remaining part of the week. Now, Google, we finally got called away on Google after being in the trade for roughly 2 weeks. We're now called away. So we got assigned Google 145 after their earnings, and now we are able to write covered calls this week for Google. So our total premium acquired on Google was, you can see the cost basis down here is 144.01. So we wrote the 145s. We got about $1 in premium from those. And then we wrote the covered calls here for about $1.16 on this week. So total premium is $1 for the puts, and then $1.16 for the calls. That's $2.16 divided by our total exposure at 145. It's about a 1.5% in 2 weeks. We got assigned last week. We're out this week. 1.5% respects our 0.5% rule for 2 weeks, 0.5% a week minimum, pretty much. So I'm happy. A little bit of an in and out easy trade for Google. If it revisits that 145, I will be playing it again. Trade Desk, we're still in that one. Trade Desk has earnings over the course of this week. So we got assigned at 72 earlier on in late December right here. They're trading above that now. And since we've written such juicy premium over the past assignment period, our average cost is now down to 64.39. If they close above 71 on Friday, that's fine. We'll be pocketing pretty much a over 10%, 10.5% gain in roughly 5-6 weeks, which will be about 2% per week. So can't be mad at that. We'll see what happens with Trade Desk, but very happy running these covered calls into earnings. Now, UPS is another trade we get called away today. So UPS 145 calls. We got assigned on UPS after earnings last week at 145, and we were able to write the 145 calls this week. Now, total premium acquired on UPS, $1.07 for the puts leading into assignment, $1.81 for the covered calls after assignment, $2.88 divided by your 145 exposure. That is about 2% for the past 2 weeks. So over pretty much under my 1% per week minimum, right? 0.5 to 1%. That's at the higher end of the range. Very happy with that UPS. UPS and Google, very easy wheel in and out trades 1 week to the next. Now, we did have a few other swing trades here that we're still in. So TMF 20-year bond still in that. ETH and Bitcoin still need to add to those. Google is gone. Nike still waiting to write covered calls. Trade Desk, we went over it. UPS is gone. Baba still into it. We went over it. Palantir, they're out. So a lot of buying power will be freed up next week here, guys. Looking forward to it. CSIQ went over that as well. And my Canadian banking shares just chilling. So that's pretty much everything for the portfolio. Hope it was insightful for you guys. Yes, we had a few break-even plays in the names of Starbucks and PayPal that we closed out of. Well, Starbucks, what we pretty much lost on in terms of capacity to go get here, right? The $300 we could have got. We closed the trade roughly at a $15 loss here, but we could have got about $300 if we would have waited maybe a bit more. Well, we got that back on PayPal when we closed out here. Now the stock's about 58, 59. We had 200 shares, right? So that's pretty much $4. That would have been about $800. So in one case, Starbucks, unfortunately, we have a little bit of a break-even trade that had some opportunity costs that we could have got to the upside. But PayPal, since we did play good risk management as a strategy, well, now we get an extra $800 in potential cost management from there. So all in all, fairly good decisions on the week. More buying power, just want to accumulate as much buying power as possible for the next couple of weeks if we do get some dips. So very, very happy. We've been making, over $1,000 a week, which is pretty much the title of my video, how to make $1,000 every week trading the put wheel strategy. So we're back to pretty much our normal term swing trading the wheel strategy at this point, right? And that is the premiums that I'm going to be looking to make now that we have all this additional buying power. We're just back to basics, guys. Less and less assigned positions in the portfolio, more buying power for just regular week-to-week wheel trades. So hopefully that's been helpful. If it has been, just drop a like on the video. Would really appreciate it, guys, if you could do that for me for the YouTube algorithm. And as always, subscribe to the channel if you're new. We'd love to have you here. Thank you so much to all 700 of you who have subscribed so so far. You've made the journey more than worth it. And as usual, if you have any questions, guys, always feel free to leave them down below in the comments. I usually answer within the first 24 hours. Anything whatsoever, guys. If you want me to cover a specific stock, technical analysis, an earnings play maybe I didn't review, or any questions or suggestions for the channel, please leave them down below. Thank you very much for all of your support and engagement so far. I'll see you over the weekend. I'm going to be doing one educational video tomorrow and the top 5 options plays on Sunday night. So take care. Have a great weekend. Peace.